Credit default swaps. It's easiest to think of a credit default swap as simply an insurance policy. Credit default swaps are typically 5-year contracts on a bond that is issued by a company or a government. One side of this insurance contract pays a premium, some amount on an annual basis. The other side promises to pay $10 million for the bonds if they default. While I say that it's similar to insurance, and that's how I think about it, it's not exactly like insurance. Most notably, you don't have to own the bond in order to insure it. For example, I could buy a credit default swap on IBM's bonds even though I don't own any of them. The result is that I can use credit default swaps to insure, but I can also use them to speculate on bad things happening to a company or a country. In addition, if I don't own the bond, but I own a credit default swap, I may want to see bad things happen to that company or country. We watch credit default swap premiums to understand the market's sentiment on a particular issuer. When these insurance premiums increase, it tells us that the market is scared about this issuer. Credit default swaps have received a lot of blame during the recent financial crisis. Some issuers sold too many of them, creating systemic risk. In other words, insurers like AIG promised to make everyone whole if their bonds defaulted. They didn't have enough capital to back it up. This is Sandy Leeds on credit default swaps.